The Finance and Investment Cell of Shri Ram College of Commerce welcomes you all to today's session of Shri Ram Financial Forum. We are extremely delighted to have amongst us our guest of honor, Dr. Ajit Ranade. We welcome you, sir. Sir is currently the Group Executive President and Chief Economist with the Aditya Birla Group, a multinational conglomerate with operations in more than 40 countries, with a business ranging from metals, mining, to telecom, retail, insurance, and asset management. He is a member of the Economic Policy Council of the CII, a member of the National Executive Committee of the FICCI. Sir is a board member of the Gokhale Institute of Politics and Economics, a member of the Governing Council of Center for Advanced and Financial Research and Learning of the Reserve Bank of India, and he even heads the academic board of Meghnad Desai Academy of Economics. Dr. Ranade has also been the chief economist at ABN Amro Bank and a consultant to the World Bank. He is currently the professor of Indian Council for Research on International Economic Relations and chairs the research advisory panel of the Indian Institute of Banking and Finance. Sir is an engineer and management graduate from IIT Bombay and IIM Ahmedabad respectively and holds a PhD in economics. It is indeed an honor to have you with us today. I would like to mention that our teacher in charge, Ms. Saroj Joshi, had to join, but she couldn't due to certain network issues. So, sir, we can.
Thank you, Arushi. Thank you, and good morning to you, and thank you very much for the very kind introduction. And I'm very happy to join you at the Finance and Investment Cell (FIC) of SRCC College. I think it's been quite some time since I visited, so very happy to be here. And today I would just like to discuss about some aspects of the economic outlook, both globally as well as in India. But I really look forward to actually an interaction. So my topic today is economic outlook. And I just want to say one thing in the beginning, that the economic outlook for most of the world has become quite bright, is really has improved a lot. And two of the largest economies in the world, namely USA and China, are expecting almost like a booming economy. The USA is expecting to grow by 6% GDP growth rate. Remember, the USA is almost 7 times bigger. And if they grow at 6%, it is like, it's a huge growth. And China also is expecting to grow at 8.5%. So together, both USA and China together, if they, there's 30, that they represent $35 trillion of the global economy, which is almost 40%. So if they are growing at 5%, that is like India growing at 50% GDP growth rate, 50. That's the scale of the impact. And the reason for this brighter economic outlook, in fact, you'll be surprised to know that there are, even as we speak now, there are some 8 million jobs in USA for which they can't find people, job announcements, shortage of people. Of course, those jobs are in various sectors at various levels of seniority, or they may not, many of them may be jobs in the services sector at the low end or whatever. But that's the kind of seriousness, of the situation, in the sense that they actually now have not job shortage, but people shortage, workers. And the reason for this, by the way, is two. Even though we are in India in the middle of the pandemic and we're still struggling and anticipating a third wave and so on and so forth, we'll come to India in a little bit. But the reason for this huge optimism in US and China and other parts of the world also is two. There are two reasons. Number one is vaccine optimism, and number two is fiscal stimulus. So number one is vaccine optimism, means that the pace of vaccinations the progress, the fact that it's being done rapidly is very significant, and that is causing both consumer and business confidence to come back. And the second is that about fiscal stimulus. The fiscal stimulus in USA, for example, is 15% of GDP, 1.5. In India, last year we had barely 2%. I'm talking about fiscal stimulus towards pandemic effort. So even though last year we had announced all kinds of things, but if you look at only the fiscal stimulus, not monetary stimulus, it is much smaller. So also in China and other parts of the world. So that's the broad economic outlook for the world. It is going to be a year with a strong growth, and of course other aspects like inflation. So we'll talk about that. So that's the beginning. So let me just go to. If you look at the global economy, it is rapidly recovering from COVID. If you look at this graph, this chart, it shows the projections, that is predictions, forecasts made by World Bank and IMF for the entire world. So you have USA, Europe, Euro area, Japan, China, India. India FY is for fiscal year, Thailand, Brazil, and so on and so forth. But you can see that the latest forecast of June 2021, which is the second column, is for USA 6.8%, Euro area 4.2%. These numbers they have not seen for a long time. China 8.5%, India is 8.3% this year, fiscal year, that is April to March. Thailand is relatively lower, 2.2. Brazil is also low relatively, 4.5. And the world growth in PPP terms is going to be 5.7%. And EMD, the emerging market developing economies, excluding China, that is the last row, is 4.4%. So one thing I would like you to notice is, first of all, if you look at the second column and the fourth column, there's been a huge upgrade. So back in January 2021, just 5 months ago, the US forecast was only 3.5%. It has been upgraded to 6.8%. The Euro area was at 3.6, upgraded. Japan upgraded. So there's been a revision, optimistic revision for growth forecasts. The other thing I'd like you to note is all the developed countries, the relatively rich countries like USA, Europe, Japan, they are growing much, their growth prospects are much stronger than developing economies like Thailand, Brazil, or even India, I would say. India was, last year, we expected that 2021-22 recovery will be like 10 or 12% because last year was -8, -7.3. But actually, it's going to be, in fact, lower. We had to tone down our forecast from 12% to maybe 8.5 or 9% because of what happened in the second wave. So that's the global economy, okay, outlook. Message is rich economies, developed economies, very strong growth prospects, including China. Developing economies growing somewhat slowly. For example, Thailand, which normally would have grown at 5 to 6%, is going to grow only at 2% because a lot of the Thai economy depends on tourism, and tourism is still not picking up, especially in the developing countries. So what has helped this recovery? Why are we suddenly much more optimistic about the global recovery? Number one, unprecedented fiscal stimulus. Sorry. Am I still sharing my screen?
Yes.
Sorry, there's a disturbance.
Yeah, sir.
Can you see the screen?
Yes, sir, it is visible.
Yeah, so what has helped the recovery? Number one is unprecedented fiscal stimulus, estimated at 15% of world GDP in 2020. And this year also close to 15%, at least in large countries like USA. This is very, very large, okay? Normally our fiscal deficit is supposed to be like 3% of GDP in normal times. That is the maximum limit from fiscal responsibility legislation or fiscal discipline point of view. So, and large economies typically tend to have smaller fiscal deficits compared to countries like India. But they themselves are running a deficit of 15%. And by the way, this is direct injection, cash injection. This is money going to, this is money going to the people's household pockets directly. This is money being paid to companies to pay for the salaries of their workers. So this is not like liquidity support or loan guarantees. This is actual fiscal stimulus. In addition to fiscal stimulus, we also have support from central banks, which is monetary policy. So fiscal policy is loose, monetary policy also. Low interest rates, high liquidity, enormous amount of loans given and loan guarantees and so on. And also there are no significant default events like bank, loan default or bank failures, because in many economies, there have been debt forbearance policies. What does that mean? There have been policies to say that if a loan is due, then give it some more time. Moratoriums, restructuring, repackaging of loans. So that means no defaults or no danger to banks. And then, of course, the great success of vaccine rollout. The New York Times had said before, just when the pandemic, last year, about 1 year ago, they say, oh, we'll need a new vaccine, and a lot of vaccine research has to be done, and then there have to be trials, phase 1, phase 2, phase 3 trials. It'll take about 10 years, 8 to 10 years for vaccines to be developed. But so many vaccines have been developed in just 2 years, less than 2 years. So this was great success, and it's actually a testimony of global coordination and globalized efforts. What is the flip side? The flip side is that, unfortunately, we have now more inequality, increasing inequality in all nations, developing as well as developed nations, and also within nations. So what is happening? For example, I'll give you some examples of inequality. We have now 60% of the vaccine doses have been given to only 16% of the population. Much of the rich countries have already progressed because they have access to vaccines, and some of them are unfortunately hoarding vaccines. Whereas the poorer countries, the pace is very slow. I mean, in India, we are trying, but if you look at other countries, the poorer countries or less developed countries, the vaccine rollout is very, very slow. So that is one example of inequality. But there are many, many other examples of inequality. The fact that the stock market is doing so well. Now, people typically, it's the higher income people who invest in stock market. So the stock market going up means their wealth is increasing. So wealth inequality is worsening. Income inequality is also worsening. We are also seeing digital inequality. The fact that I'm talking to you over Zoom session. So all of us have access to digital. We have digital access, so we have bandwidth access, but not everybody is so lucky. Not everybody has a smartphone with good access to Wi-Fi or with good access to network. So, and then what to speak of digital, not everybody is as comfortable learning or gaining education through the digital medium. Imagine the lakhs and millions of people, children, students in rural areas. The whole family has only one smartphone, and the smartphone has to be used to do online classes of 6th standard, 7th standard, 10th standard. So whereas in people in cities like Delhi or Mumbai, or in good schools like higher end schools, their education is going uninterrupted. So there's going to be an educational inequality as well. So that's the flip side of this pandemic, that inequality is getting worse. And of course, the levels of debts are going up across countries. That is debt to GDP ratio of governments. We have increased debt levels, and we also have asset inflation. We have stock market going up, and now commodity markets also going up. So the new threat is that is coming up is actually inflation. Inflation is high. I just told you that the stock market is going up, so asset prices, stock prices are going up. But of course, nobody feels unhappy if stock prices go up. If Reliance or TCS or Infosys or HDFC Bank, these stock prices go up, that we don't call it a bad inflation. That's good inflation. But if your prices of vegetables, onions, potatoes, or other food products, food grains, pulses, oil, petrol, diesel, if that goes up, that is going to affect our inflation. So inflation is a threat. And it's coming, it's combination of the fact that we have high liquidity thanks to the loose monetary policies. And there have been some supply chain disruptions. If you remember that large ship which got stuck in the Suez Canal, but that's just a symptom. That's just a, I mean, I guess it's a symbolic thing of how there are so many supply chain disruptions, which are causing some commodities and items to become expensive. And of course, so in India, for example, edible oil, the oil which you use for cooking, that price has gone up by 100% since last year. Sugar has gone up by 60% since last year. Milk prices are up, medicine prices are up. Global food index is at a 7-year high. Prices of commodities like copper, aluminum, iron ore, steel, they are very high. Freight rates are also at a decadal high. Freight rates are the shipping rates. When your goods are moving across ships, whether it's crude oil for petrol and diesel, or iron ore, or steel, or metals, specialty chemicals, the cost they have to pay to shipping, that's really zooming up. And of course, equity markets. So as a result of that, look at the inflation. In the USA, the target rate is 2%. For them, 2% is acceptable. Anything above 2% is bad. If you look at the last column, in May 2021, the US is at 5% inflation. Euro area is already at 2%. I mean, their normal level of inflation is close to 0, 0.5. Japan well, inflation is kind of low right now in Japan. In China, it is also relatively not so bad yet. In India, it's already gone up. In May, it was 6.3%, but it may still go up. Wholesale price index-based inflation in India is already at 12.5%, 13%. It's going to be in double digits. In Brazil, it's 8%. So that's the new threat. And I told you, because of that is also the inequality related. Inflation is a tax on the poor, by the way. So inequality is something which is the other threat. Inflation, high inflation, and widening inequality. These are the two threats. I would say the economic outlook is bright. Economic growth is coming back. Global trade is picking up. But the two threats are inflation and inequality. I told you about inequality in wealth. I told you about inequality in income. I told you inequality in digital access. But another inequality is the inequality in jobs. Actually, you find that the higher skilled people who have college education, postgraduate education, economics degree, let's say, or in data sciences, in STEM, science, technology, engineering, management, MBA, the higher skilled people actually have job growth. The red graph is actually growth, job growth. The below the line is unemployment, negative job growth. That is actually contraction. So across the world, this is a chart showing data from across the world: Chile, Mexico, USA, Turkey, Israel, Spain, Estonia, Czechoslovakia, and so on. I think India may be missing in this graph. But across the world, we are seeing that higher skilled people are getting jobs. Their salaries are increasing. They are in big demand. Their supply is in shortage. But lower skilled people are not able to find jobs. Even in India, we found the same thing. When you had the lockdown last year, you saw what happened to the migrant workers, the informal sector. So that's the challenge. So the outlook now will depend on basically the pace of vaccinations. If you look at this chart, which shows that which countries have achieved. So there are countries which have achieved more than 50% of the population are fully vaccinated with both the doses. Israel, Bahrain, Mongolia, they are small countries. But there are large countries where 30 to 40% of the population is also fully vaccinated. USA, UK, Chile, Singapore. So they are going to, the economic outlook there is very bright. There are countries where 20 to 30% of the population has been vaccinated. Italy, Germany, Switzerland. Now remember, countries like Italy, Switzerland, or Germany, they don't manufacture vaccines. The vaccines, 60% of the global vaccines are produced in India. India is factory to the world when it comes to vaccines. But these countries have managed to, because they put advance orders. They put in the orders last year in advance. So the suppliers are able to supply vaccines. In India, I think the rate, the percentage which have had both vaccines, both the doses done is barely 3 or 4%, and about 10 to 15% have got at least one dose. So we have some way to go we are hoping to catch up by December. That's the main determinant of the outlook. So, in terms of what to look for in the next 1 or 2 years, is that we have to look at for global factors. I would say the spending on infrastructure that's happening in developed economies, including large economies like USA, increased government spending, fiscal stimulus I mentioned, higher consumption as mobility and income revive. Mobility is not mobile phones, but mobility. That is, people start traveling. Because, one of the sectors which was badly hurt is airline travel or hospitality, tourism, hotels. So as that comes back, consumption spending will pick up. And of course, the global trend is also higher digitization, work from home, productivity gains. What we need to watch out are inflation. I just mentioned that. And when monetary policy starts reversing, and the fact that we now are going to have higher taxation with so much fiscal spending and such high levels of debt to GDP ratio, we're going to have higher taxes. In fact, the US Secretary of Treasury, that is what we would call Finance Minister, Janet Yellen, she has said that we should have a minimum tax of 15% on corporations. So that increase in taxation is something which is going to be a negative factor. And of course, the other big thing to watch out is the China versus rest of world conflict, the China-US trade friction. For India, I would say the factors to watch out are vaccination pace, then higher capital spending by the government, infrastructure spending, and improving corporate balance sheets. I think corporations, especially in the organized sector firms, they're doing well, they're hiring. I think job prospects are getting better, especially for higher skilled workers. And of course, what we need to watch out for is the third wave, which is anticipated next month or even August, and the fact that fiscal space is very limited for the government. But I want to say that the positives are that corporate balance sheets have improved in India. That is, if you look at the January, February, March corporate results, very high growth in profits. And that was partly because of cost savings. And that is reflected in the stock market. The stock market in India is very optimistic. And partly it was because of corporate results, and partly it was driven by large cap companies. I would say that the higher infra spending, especially on roadways and all, is a positive that creates demand for cement, for steel. And when you have, that can also extend to real estate spending. And if it comes to housing, then that has a multiplier effect as well. So that is one thing to watch out for. And of course, exports. I think in the last 4-5 months, India's exports have been about $150 billion, $140 billion. Because the world economy is booming, we should try and take advantage of the fact that increase our exports in a big way. Actually, what happened in the last 5 years, our cumulative growth in exports, especially of goods, was almost zero. But we must take advantage of the fact that the world economy is booming. So I think if we are able to, say, have a growth of 10-15% in exports, that in turn will create employment. That in turn will have an effect on industrial growth, because exports and in the manufacturing sector, they're completely intertwined. And of course, we are also expecting a normal monsoon. In fact, we've had, in much of the country, we've had rains already. And anticipated growth in agriculture will be around 3% or 3.5%. We expect a record agriculture output of food grain of some 305 million tons. So all that is on the positive side. On the negative side, I said, is that we have to watch out for inflation. It's coming partly because of the global demand, and it's partly coming because of, for example, our excise policy on petrol and diesel. Petrol prices have crossed 100 rupees, and big contributor to that is the excise tax collected. So we have to worry about inflation, and we have to worry about inequality. I mentioned that. And the third thing I think we need to worry about is job creation also. I think At the higher end, for skilled labor, skilled workers, the job prospects are good, including in the IT sector. But large-scale job creation, that is at the scale of 2 crore jobs a year, 20 million jobs a year. That is a challenge we need to be aware of. And that will come only when business confidence picks up, when businesses start hiring.
So as the session draws to an end, I, on behalf of the Finance and Investment Cell of SRCC, would like to extend my heartfelt gratitude to Mr. Ajit Ranade, who took out time from his schedule to share his wonderful insights with us. I would also like to thank Meghna Desai Academy of Economics for organizing this session. And I would also like to thank Ms. Saroj Joshi, our teacher in charge, for her support, and all in attendance for today's session. Thank you so much for making this Shri Ram Financial Forum session successful.
Thank you. Thank you. Thank you for having me. Thank you.
Thank you, sir.